Now, the same folks are worried about U.S. interest rates rising and money is being pulled out of emerging markets. India and Indonesia also took the brunt of the sell-off, and analysts are worrying that there's a domino effect that could spread to other emerging markets. Joining me here in the studio is Saruhan Hatipoglu, CEO of Beri Consulting. Saruhan, good to see you.
See you too, Phil.
The last couple of weeks, we have a problem. What is going on in emerging markets? I mean, nothing has changed. We knew that the Fed was going to cut back, but why this sort of fear that's taken place in the emerging economies?
Well, I don't think it's only the Fed that has done the tapering announcement that caused the problems in the emerging markets. There's a slowing down in China, and China used to buy a lot of products from emerging markets. So China is slowing down. And finally, there was some kind of a belief about political stability in emerging markets that has been there for the past 2 years. Now that's gone with what's happening in Egypt, Indonesia, South Africa, Turkey. We can increase the examples, actually. So all these things put together created the perfect storm and scared away the investors. Now the problem is, or the question we need to answer is, I guess, is this a temporary setback, or is it a problem with the fundamentals? I think that's going to matter quite a bit in terms of what's going to happen next.
This slowdown in China from 9% to 8% to, 7, in the low 7s to mid 7s. Obviously, it has an impact on countries like Australia, who export a lot of commodities, but it also has an impact, to greater Asia as well. You look at Indonesia,
Sure.
Thailand. I mean, there's little mini hubs of manufacturing. How does the slowdown in China impact those countries, and is it a big enough deal where they need to really panic over it, or are the economies diversified enough to where they can overcome it?
Well, if the problem was only slowing China, that would not be a big problem. Emerging markets would actually recover. But again, all these three things coming together with the U.S. interest rates about to rise, political instability taking place, and the governments that are taking kind of interesting policy measures toward these problems is what's creating the problem. Enter Indonesia, we're talking about, right? The fuel subsidies were cut in June. Right? And the gas prices rose 40%, about 40% actually. That created a lot of controversy in the country. Foreign investors are scared because they remember 1998 Suharto regime and what happened to it.
The Asian crisis. I want to just stay right here for a second. I want to talk about Malaysia, and we're going to come back to you. Malaysia, of course, among one of the big emerging markets that got a hit with this sell-off as well. Now, despite the drop, the economy has been relatively less affected compared to its neighbors. But here's something you might not know. The country is known as a low-cost manufacturer because of low-cost foreign workers, which are all from poorer Asian countries around the area. Economists say this isn't healthy for Malaysia's long-term goals. Ryan Metzer has this report from Kuala Lumpur.
A full 8 out of 10 workers at this plastics factory in northern Malaysia are foreign. While Malaysians do the more highly skilled jobs, workers from Nepal, Bangladesh, Vietnam and Indonesia do the unskilled work. There are more than 2.2 million legal foreign workers in Malaysia, almost 1/5 of the country's workforce. Aside from factories, they work in Malaysia's restaurants and homes, act as security guards, work in palm oil plantations and mills, and make up nearly all the labor force on construction sites. Employers say Malaysians just don't want to do the types of jobs the workers from poorer countries will do. The so-called 3D jobs: dirty, difficult, and dangerous. And with unemployment barely ever rising above 3%, Malaysians can afford to be picky. But economists say having easy access to cheap foreign labor has a serious downside.
So one of the key problems that Malaysia face is actually this reliance is still continuing, and it has a long-term effects of retarding our so-called structural change of moving up the value chain and moving it towards what we call more capital-intensive kinds of industries.
Employers say the use of foreign workers remains vital in industries such as plantations and construction. But even the Malaysian Employers Federation acknowledges that it's far from ideal, with lower skilled foreigners sending all their extra earnings back to their home countries.
If we pay high wages to our own employees, then the employees would actually spend the money here. And of course, that will boost up the economic activities around the country.
The #1 source of foreign labor here is Indonesia.
But as Indonesia's economy booms, its people are finding it easier to get decent work at home. Still, there are more than enough people from poorer countries such as Myanmar and Bangladesh who would be happy to step in to fulfill the needs of Malaysia's employers. Ryan Meltzer, CCTV, Kuala Lumpur.
All right, we're back with Saruhan Hatipoglu. So here we go. The story is we've got low-cost workers from foreign countries working in Malaysia or other countries for that matter. And as the economy slows, not declines, but slower growth, there's an impact to this sort of lower, less educated, less high-earning, but semi-skilled workforce. Who gets hurt the most with slower growth? It's not the rich, I don't think.
It's not, unfortunately, in this case, because especially in Malaysia's case, the people who are hired temporarily for low-skilled jobs will be the first to go. So there's going to be a social impact.
They're the first to get fired.
They'll be the first to get fired. Social impact is going to be felt in that country. But it's also going to affect production. So there's the domestic component of it. In terms of who's going to get hurt, and if you look at it from a social perspective, again, it's going to be the low-paid workers, definitely.
But you need the low-paid workers because the low-paid workers work at these factories that produce low-cost goods that end up getting sold everywhere from America to Europe to China to Japan. If some are saying, well, as wages continue to rise, who ultimately pays the price?
I'm glad you asked me that, Phil. There was a survey by IT Carney that was released in June, Foreign Direct Investment Confidence Index. And what they do is they survey global executives in charge of companies make about $2 trillion in global revenue. So they asked these individuals, the leaders, what they think about labor costs going up in China. Would that affect their FDI decisions? 2/3 of the leaders said, no, we would still stay in China. So substance matters. China has done well, macroeconomic certainty, there'll be crisis, mini crisis, this and that, yes, but substance matters, and foreign direct investment, in terms of foreign direct investments, leaders see that. So it's not like it was before, where labor costs go up immediately and people leave the country.
Remember well, you do, I'm sure you remember the Asian crisis in the late 90s, then we had the housing blow up, and a lot of these are related to credit.
Right.
Borrowing too much money that nobody wants to pay back, and we all write off a bunch of debt and then foreigners run away. Are we at that stage with Asia, with any of these countries? Is there any worries that perhaps maybe people have got a little overexcited the last couple of years?
I was a student, a master's student, and I remember it perfectly. We studied it, actually. But I don't think the situation is similar, and I'll tell you why. The Asian crisis, it was the multinational companies that were ridden with bad debt, right? They couldn't pay anymore, just like it happened
And
here.
the governments, too.
And the governments, too, but most of the time, I mean, imagine what happened here in 2008, 2009, the crisis, how the U.S. economy was affected. 15 years ago, think about an emerging market. They had the same problem. This time, it's not large multinationals, it's the consumers that have a lot of debt. So in a way, that's good news. The second thing, a lot of the borrowing in the bond markets are done in long term, and they're done in local currency. As opposed to the Asian financial crisis, it was short term and U.S. dollar. So we're not seeing that.
Very quickly, are we or are we not in a crisis the next couple of weeks here? Because there are some very nervous investors. If you're watching what's happening in the world, there is a problem.
We're certainly, as far as our clients are concerned, Beri, we are having a crisis, and they're right. We have to watch what the governments are going to do, because government policies, in terms of how to deal with these problems, will make the final decision or change the outcome, if you will, about what's happening today. It might not be a crisis, or it might just be a mini crisis. That's not going to turn into full-blown crisis. It's up to the governments.
Okay, we're watching it very closely. Saruhan, thank you very much.